Hey, how's it going? Bill Lethman here for Money Evolution. In this video, we're going to be talking about how one flat or sideways market could destroy your retirement. So I did a video here, actually just recorded it right before I'm recording this one. That should be up on the YouTube channel already, and it's really about how to create a bucket strategy for creating $120,000 a year of retirement income. And I got into all the details about how the bucket strategy works and what some of the risks are with that bucket strategy. But in this video, I really wanted to talk into a little bit more detail about what actually happens when we go through a sideways market and how you should theoretically operate those buckets and what's going to happen and what is the potential risk for your ability to maintain your retirement lifestyle. So we're going to be going through another hypothetical situation here. Again, just a hypothetical. Your situation, of course, may be a lot different. We're going to be talking about a hypothetical person that wants to get $80,000 a year out of their portfolio. They have $2 million of total portfolio assets. So we're going to get into the details of that, but real quick before I do, if you want to learn more about what we do at Money Evolution, go over to moneyevolution.com. You can check out some of our free resources, our blog over there, learn more about our financial planning programs that we do for clients, and then we'll put some links down in the description to all of that, as well as some of the free resources that we have. Okay, so let's start mapping some of this out. So again, our hypothetical client situation here, we're going to say has $2 million of portfolio assets. Really doesn't matter for purposes of this if they're 60 or 65 or whatever. We're just going to assume they have $2 million of investable assets and they need to take out $80,000 per year. So right away, we do some simple math in our head. You probably have already done it. You know that $80,000 on a $2 million portfolio is exactly 4%, and that's our general rule of thumb that we kind of subscribe to. Again, it's just a rule of thumb. There's been a lot of research that's been done on this, but basically the 4% rule, if you're not familiar with it, is that if you limit your retirement withdrawals to 4% or less of your portfolio, you have an above average chance the money's going to last you for the rest of your lifetime. When that research was done back in the early 90s, it was to forecast a 20-year retirement, and the meaning of success in that study was that you had at least $1 left in the portfolio at the end of a 20-year period. So depending on how old you are and your longevity and everything, 20 years may not be enough for a lot of people. You may actually spend 25 or 30, even 35, or some people 40 years of your lifetime in retirement. I actually have a grandfather that's going to be turning 97 here soon, and I think that he retired in 1986, and so I'm trying to do that math. I didn't think about that ahead of time, but that's a long time to be spending in retirement. So hopefully you will have that kind of longevity as well. But anyway, the original 4% methodology was based on a 20-year retirement. So in my last video, we talked about how to set this up using the bucket approach. I'm going to go through that here relatively quickly here, and you've probably seen me do it, or maybe other people have talked about the bucket strategy. This is a fairly common methodology for how to kind of set up your assets for anticipating some of those retirement withdrawals. So buckets number 1 and bucket number 2 is going to be more of our short-term spending needs. Basically, bucket number 1, you're going to want to have about 2 years of cash flow needs in that bucket, and then additionally another 5 years of cash flow needs there. We're going to keep things simple here. We're going to leave inflation and taxes out of our situation that we're doing on the whiteboard here like we usually do, because that gets a lot more complicated and a lot more involved. And that's where really having a software tool that can calculate the taxes and calculate inflation over time and the growth rates of the portfolio and the variability of your gaps. We're assuming that you just need $80,000 a year for the rest of your life. Most people, that's not usually the case. You've got all kinds of different things that are happening. People, one spouse retiring earlier than another, or one spouse older or younger and getting Social Security at a different age, and paying off a mortgage, and all kinds of different things create more variability than just having $80,000 per year. But again, we're keeping it pretty simple here. And we're going to say that to fill up buckets number 1 and bucket number 2, you need $480,000 to put in those 2 buckets there. Again, just keeping things really simple. That leaves $1,520,000 left over to essentially be in your growth bucket. And the idea of the bucket strategy is that as long as the markets are going up and you're making some returns, or at least you're not going backwards, every year you're going to want to replenish some money that's in bucket number 2 from the growth bucket. In this case, you're going to want to do that for $80,000 for every year. And then bucket number 2 is going to maybe pay off some interest, or you're going to move some money from bucket number 2 to bucket number 1, and that's going to replenish that. In this case, that'll also be $80,000 per year. So the idea is that you're always going to have 7 years of cash flow needs in bucket number 1 and bucket number 2. But what happens if the market goes down? I should say not if the market goes down, but when the market goes down, because it does go down. And that's a fact of 100 plus years of stock market data. And sometimes the market does very well. And essentially, it's done very well for the last 15 or 16 years. Really, since the bottom of the great financial crisis, when all the banks collapsed and everything, we've been on a pretty nice upward trend here. We have had a couple hiccups along the way. We had a little bit of a downturn. For example, in 2018, we had COVID crash. In 2020, we had another market downturn in 2022. And all of those recoveries that we've seen in those last 3 or 4 market downturns have happened very quickly. You know, we bounced back within a relatively short period of time. But that's not always the case. In fact, that may not even be the norm as far as market recoveries go. If we go back to the dot-com bubble, that peaked in 2000, took 3 years just to get down to the bottom in around late 2002, and then it kind of rebounded down again to a low in 2003. They kind of recovered slowly over the next 5 years or so, and then just around 2007, 2008, the markets peaked again at about the same level that it was in 2000, and then we went down even further than we did in the dot-com bubble. We went down 57% in the dot-com bubble. So if we look at that, about 12 years essentially where the markets went sideways with 2 pretty massive losses that we had in there. So, so if we start here at 1,520,000 and maybe the market kind of muddles along, but, we kind of dip down and then the market kind of slowly recovers. So the idea of this bucket strategy, and again, there's absolutely no guarantee that this would be the case, but the goal is hopefully that 7 years, we can let the buckets 1 and 2 drift down and keep taking that $80,000 that we need every year out of those buckets, and hopefully, within that 7-year period when bucket 1 and 2 end up at 0, hopefully we're back up to at least where we started at. We're back up to $1,520,000. But what does that look like, and what should we do if that is the case? If we basically go sideways and we have a bunch of downturns there, we don't want to sell our growth investments at a downturn. But when we finally get back up to even and those bucket 1 and bucket 2 assets are down to 0, we want to use that as an opportunity to replenish that. So we're going to essentially take another $480,000 out of the growth bucket, and then we're going to refill our buckets. But now we only have $1,040,000 left in that growth bucket. And so what does that mean? What does that look like? Well, assuming we're going to continue to take that $80,000 out per year, we're going to essentially hopefully get some growth, and then $80,000 is going to come back. Let's say we go into sort of a normal market environment. Well, if we think about this, we can just do some simple math. $80,000 of a $1,040,000 portfolio is roughly 8%. So if this growth bucket is not making at least 8% per year, then this growth bucket is also going to be depleting at the same time buckets number 1 and bucket number 2 are being used to fund some of those expenses and things. So you could see where basically just one flat or sideways market can put us in a position where now our withdrawals essentially are not 4% anymore, but they're 8%. Not quite 8% because we still have the growth bucket, but it's 8% of what's in our growth bucket because we still want to continue to replenish that. Now, sometimes after a market downturn, we can see above average returns for a few years, because things generally go down more than they should. They overextend to the negative, and then markets get overvalued and they overextend to the positive here. But I wanted to kind of lay this out because sometimes people think the bucket strategy, it is a good strategy, and it's what we use. There's other things that we use too. I talked about it in my last video about adding additional predictable income sources can really help to reduce the risk of this strategy working and give a lot more confidence to the overall situation. But again, there's no guarantee that the markets would bounce back within 7 years. In fact, after 7 years, those assets could still be significantly less. So one of the things that you should do is looking at your expenses, look at what are the expenses you have to have, your absolute, your basic needs, your housing and your food and groceries and transportation costs, insurance costs, health insurance, things like that. Those are things that you might be able to cut back a little bit on some of those things, but it's going to be things that you need all the time. And then what are some of the expenses that you have that are more discretionary? And that's going to be more of your entertainment budget or travel budget and things like that. And I get it. You've worked your whole life, you've saved money, now you're going to be retired, and now you want to start enjoying that. You don't want to go through a downturn in the market and then have to cut back on all of your expenses, but you should know what are some of those expenses that are a little bit more discretionary. And if we're watching a market that is going sideways, maybe thinking about cutting back a little bit and reducing some of that spending so that maybe if we don't quite recover in 7 years, you've got a couple more years to add on to that. We talked about in the last video, adding some predictable income sources. I'm not going to get into the detail like I did in the last video, but things like dividend income, that's something that tends to be a little bit more predictable. Of course, dividends are not guaranteed either, but that's something that could give you some income that maybe instead of needing $80,000, now you only need $60,000. You've got some basic expenses covered. The one thing that gets a little bit tricky about a dividend portfolio is that if you really need 80 and you're only getting $20,000 from those dividends, then you're going to have to take bigger chunks of the other parts of the portfolio that aren't allocated to those dividends, unless you could somehow build up the dividend portion of your account to get enough dividend income that it covers all or the majority of that $80,000 gap. We talked about an annuity as a way to get some predictable income. As we film this in late April 2025, annuity rates are really good right now, and depending on age and things like that, there's a lot of good opportunity for getting some predictable income that's coming in that's contractually obligated from an insurance company that's going to pay for the rest of your lifetime. And if you're married, it can be tied into a joint income as well. So that's something that if you want to learn more about that, you can check out the end of that last video that is talking about the bucket strategy and creating $120,000 of retirement income with a $2 million portfolio. But anyway, so I hope that makes sense there a little bit with regard to how to set this up and how to manage this. And as you go into retirement, just knowing some of your numbers and understanding what your gaps are. Again, as I do these hypothetical illustrations and things, they are meant to be overly simplified, but to give you the ideas and some of the concepts that you could be looking at in your own portfolio, but really having a formal financial plan using some software, using some high-end software that's going to be able to calculate taxes and be able to account for the variability of expenses and even variability of income that's coming in. We've got all kinds of different situations, clients that have deferred compensation that's paying out for a few years in early retirement, or you've got one spouse that's going to work a little bit longer than the other spouse, and then Social Security timing strategies to have one spouse collect a little bit earlier, but the other one delays to more maximize that, and really sort of fitting together all of these different pieces and like a big puzzle, essentially, and putting them together in a way that's going to be the most optimized for you and your retirement situation. So we have 2 programs that we do through Money Evolution that can help you with this. One of those is our very high-end, very customized one-on-one financial planning, which is called the Money Evolution Plan. We build a whole plan out for you. We work together through a series of 4 meetings to design your plan, really lay out every aspect, help you optimize for Social Security, for creating retirement income, for tax optimization, get into Roth conversion strategies, all of that. And then we have our Retirement Time Machine, which is still a fantastic program, uses the same software as the Money Evolution Evolution plan. We build a plan out for you. It's a little bit more educational based and DIY, but it does include a meeting with our team so we can go through the plan, lay out some basic strategies and scenarios and things like that. But it's a good tool to be able to see that big picture and understand the cash flow in particular, because the cash flow is where all of that variability is going to come in there. So anyway, so check that out. We'll put links to both of those down in the description below. We've also got some great free resources as well. Our Retirement Launchpad free guide to help you get organized and start to really start thinking about some of the things as you go into retirement. And then we've got our Ultimate Retirement Planning Checklist as well that goes through every single item that you should be thinking about in the years going into retirement and the early stages of retirement. And we'll put links to both of those things down in the description below. Completely free. It's a good place to start, and check that out. Hit subscribe, and I'll see you back in one of our next videos. Thanks.